You know that old saying, if it looks too good to be true, it probably is. Well, every now and then, you find something that makes you wonder. Today, we're diving into Supermicro computer. We've got a report here that basically says it's a fantastic, top-tier opportunity and a huge risk. So how on earth can it be both? Let's get into it. And right away, here's the central puzzle we're trying to solve. You've got a stock with a glowing 5-star rating, and it's supposedly trading at a massive discount. So what's the catch? I mean, really, why isn't every investor on the planet jumping on this? That's the big question we're going to explore. Okay, so before we get lost in all the financial jargon and the ratings, let's start with the basics. Who is Supermicro? What do they actually do? So a really good way to think about Supermicro is like a picks and shovels company, but for the modern AI gold rush. They're the ones building the heavy-duty gear, the high-performance servers, the massive storage systems that power all those giant cloud data centers. And here's the key part. They specialize in creating these ready-to-go, turnkey solutions specifically for AI. That puts them smack dab in the middle of this whole AI boom. All right, let's get to the good stuff, the really exciting part. We're going to break down exactly why this report is so bullish on Supermicro. This is the case for why you might get really excited about this stock. And listen, the report does not beat around the bush. It flat out calls the company a compelling opportunity for investors. Now, that's a pretty strong statement, right? So let's see what numbers are backing that up.
First up, the big one, a 5-star rating. That's the top score, the best you can possibly get. It's a flashing neon sign from the model that says, hey, this stock looks like a major bargain.
Okay, but how much of a bargain are we talking about? Well, the report actually puts a number on it. A 26% discount to what they think is its fair value. So basically, the model is screaming that the market has it all wrong and the stock price should be way, way higher.
So what's driving all this excitement? In a word, growth. We're talking explosive growth. Get this, a 5-year revenue growth rate of almost 62%. That is absolutely massive. It puts them in the top 10% of companies globally. So yeah, you can start to see why the model is so excited about this thing. Okay, so the numbers look incredible, right? It seems like a slam dunk. But hold on, remember that catch we mentioned at the beginning? Well, this is where the story takes a big, sharp turn. Because the very same report that's singing its praises is also slamming on the brakes, and I mean hard. And here it is, the catch, straight from the report. Get this, in the exact same sentence where it talks about that juicy discount, it adds this huge warning. However, caution is warranted due to this estimate's high uncertainty rating. Whoa, so what in the world is making the model so nervous? Let's dig in. To really get to the bottom of this uncertainty, we have to talk about something crucial, defense. Think about it. When a company is growing like a weed, what happens? It attracts a ton of competition, right? So the big question is, how does it defend itself? Well, the answer lies in a concept called an economic moat, and it's a brilliant analogy, really. You know how a moat protects a castle from invaders? A company's economic moat does the exact same thing. It's some kind of lasting advantage that shields its profits from all the competitors trying to storm the castle. So if we want to be a little more technical about it, an economic moat is really just a measure of how strong a company's competitive position is. Does it have something special, like patents that no one else can use, a super strong brand, or maybe just cost advantages that competitors can't touch? That's the moat. Okay, so what about Supermicro? What kind of wide, deep moat do they have to protect all that growth? According to this report, they have none, zero, zilch. And that, my friends, is a massive red flag. It means the model is looking at this company and seeing no real lasting advantage that can stop competitors from marching right in and gobbling up those juicy profits down the road. And right there, that's the heart of the problem. This complete lack of a moat is exactly why the report slaps a high uncertainty rating on its own estimate. It can see the amazing growth happening right now, but it has basically zero confidence that the company can keep it up once the competition really starts heating up. So now we have this clear tension, right? On one hand, you've got this explosive, incredible growth. On the other, this huge looming risk. Let's dive into the actual numbers and see how this whole drama plays out on the financial statements. Okay, just look at these numbers. Seriously, this is what a rocket ship looks like on a spreadsheet. We go from about $5 billion in revenue in 2022 to a forecast of almost $22 billion in 2025. That's more than a 4x increase in revenue in just 3 years. It's just incredible.
Next up is a metric called the price to fair value ratio. Now, don't worry about the name. All you really need to know is this. It's a super simple way to see if a stock is cheap or expensive. If the number is below 1.0, it's considered a bargain. Simple as that.
And Supermicro's ratio, it's 0.49. I mean, wow. The model is basically saying this stock is trading for about half of what it should be worth. And this right here is the reason it gets that coveted 5-star rating.
Okay, so we've really looked at both sides of the coin now, haven't we? We've seen the mind-boggling numbers that scream opportunity, and we've also seen the deep structural problems that scream risk. So let's try to put it all together and make sense of it. So here it is, the final summary. Let's put it on a scale. On one side, you have this massive opportunity. You've got the 5-star rating, that huge discount, and growth that's just off the charts. But on the other side of the scale, you're weighing all the risk. Absolutely no economic moat, a high uncertainty rating, and something the report calls only moderate financial health. It's a real balancing act.
And all of this brings us right back to the one big, critical question. This report paints a picture of a high-speed rocket ship, but a rocket ship with no armor plating. So the dilemma couldn't be clearer. Do you bet on its incredible speed, or do you worry about the inevitable attacks from competitors that are sure to come? According to this analysis, that's really the billion-dollar question an investor has to answer for themselves. Is all that potential reward really worth the risk?